Hey, good morning once again, options traders, and a happy Wednesday, everybody. I wanted to post a video that's a real good drill or an exercise for all of our vertical spread traders who are new, because new traders often find it very confusing if you are the long or the short spread, which option you're long, which option you're short, and how you would figure out the break-even point. So there's a great little drill you can do that really incorporates all of these ideas into one simple drill, and it will help you a lot to understand vertical spreads. So to find out what that is, let's get started. And before we do, as always, please be sure to click like and subscribe. It definitely goes a long way in promoting the channel and is always very much appreciated. So first off, vertical spreads, remember, is a strategy where you are going to buy 2 calls or 2 puts. That's important. It's 2 of each. It's not 1 of each. You are going to buy an option at 1 strike, and you will sell an option at a different strike. Now, it doesn't really matter which strike you buy or sell. It will make a difference as to whether it's bullish or bearish or debit or credit. But for right now, for a basic definition, that simply doesn't matter. You're just buying an option at 1 strike, selling an option at a different strike, but they have to have the same expiration. So for instance, let's say that you buy the January 100 call and sell the January 105 call. You're buying a call, selling a call, different strikes, but the same expiration. So that is a vertical spread. Now, to understand which one you're long and which one you're short, there's a real easy way to do it, and that is to fall back on one of the option pricing principles that we've talked about before. There's a lot of these different pricing principles out there about options, but one that is particularly important for vertical spread traders is to know that lower strike calls are more valuable than higher strikes. And conversely, higher strike puts are more valuable than lower strikes. Now, this assumes the same stock and the same expiration. So for instance, let's say that we have a $100 call and a 105 call for January. Well, the lower strike is the $100 call. So why is that one more valuable? Because traders recognize that both options cover the same period of time, the same stock. However, the $100 call allows you to pay $100 for the shares instead of 105. So the $100 call conveys an added benefit. It's allowing you a $5 discount on your purchase. And because that's a benefit in the financial markets, you're going to have to pay for that. And that's how we know that the $100 call will be more valuable. In other words, we'll have a higher price on it compared to the 105. On the other hand, if we are talking about puts, then it's the opposite. For the puts, the higher strike is more valuable. So again, both of these options cover the same period of time for the same stock. Both of them give you the right to sell your shares, but the 105 put gives you the right to sell your shares for 105 instead of for 100. So it's giving you an added $5 benefit. And because of that, the markets will push the price of the 105 put higher than that of the 100. So those are the 2 basic pricing principles that you always need to refer to when you are talking about vertical spreads. So let's now take a look at the 4 types of verticals. You can either buy a call spread, you can buy a put spread, you can sell a call spread, and then you can sell a put spread. Those are the only 4 types of vertical spreads that you can do. So once we've identified these, what you want to do for your drill is to go through each of these and figure out which option you're long, which one you're short, and then to arrive at the break-even point. Not by a formula, but by being able to figure out mathematically what that break-even point must be. So let's start with the first one here with a long call spread. And it doesn't really matter. You can pick some prices on your own, but let's say that we pay $3 for it. We know the maximum the spread could be worth is the difference in strikes, or $5, so it must have a maximum value of 2. The break-even point is 103. Now, most people know that by saying, let's either take the 100 strike down here, we have to add 3 points to that 100. Notice that our break-even point is out to the right. That means we have to go up and add 3 points to it to get to this point on our graph. We could also look at it from the credit side. We could move down and to the left, which means we must subtract this many points, 2 points, from 105. 105 minus 2 will also give you 103. Well, those are some ways to come up with the answer, but it doesn't really show you where that answer is coming from. So here's the second part of the drill, is to figure out why this break-even point is 103. So here we go. We know we have a long call spread. How is it long? Well, that means we have spent money for it. It's a debit spread. That's what makes it long. If it's a call spread, what's the only way that this could be a debit spread? We must have purchased the $100 call, and therefore we must have sold the 105 call. So now we've identified that this is the long strike. So if we get to expiration with the stock at 103, the $100 call is worth $3. We could sell it for $3. The 105 call is out of the money, right? With the stock at 103, the 105 call is worthless. So if we close this spread, we would receive a net credit of 3, and that's exactly the amount we paid, and therefore that must be the break even. All right, let's try the second one, a long put spread. So again, make up some numbers. Let's say we pay $3 for it. We know the maximum gain is 2, and we know that the break even point is 102. Now again, we can visualize this by looking at this point, the 105 strike going up and left, which means we must subtract this many points from the strike. So 105 minus 3 would give us 102. We could also look at it in reference to the 100 strike. We could come down here and to the right. Notice we have to move to the right to get to this break-even point, which means we must add this many points to this strike. So 102. So take your pick, whether you want to count from the top down or from the bottom up, you're going to come up with 102. But again, those are formulas or visual ways of coming up with the break-even point. How do you show that that's true? Now it's going to force you to understand the spread. This is where the drill comes in. So here we go. Long put spread. What's the only way that this could be a long spread? You had to pay for it. And that means if we're dealing with puts, you must own the more valuable put. You must be long the 105 and short the 100. Once we've identified that, let's see the value of each of these with the stock at 102 at expiration. Well, the $100 put is going to be worthless. It's out of the money. The 105 put is going to be worth $3, right? With the stock at 102, we have the right to sell for 105. That's a $3 benefit. So we could close this spread for a total credit of 3, which is exactly the amount that we spent for it. And that's how we know that we will break even at a price of 102. So you're getting the hang of it? Let's try another one. Short call spread. Draw your risk graph, come up with some numbers. Let's say we executed this for a credit of 2 and therefore have a max loss of 3. Break-even point is 102. So once again, we can figure this out visually by finding that our break-even point is right here. So from this strike, we can go down and over, which means we must add this many points to this strike. That would give us 2 plus 100, or 102. We could also figure it out by moving from this strike up and to the left. Because we're moving left, we must subtract. So we're subtracting this many points, 3 from 105, which again is 102. So again, those are kind of shortcut ways for coming up with the answer, but how do we know that's going to be the break even? This is where it's going to force you to understand what you're looking at. So how do we know that this is going to be the actual break even point? So let's start from the top here. It's a short call spread. Why is it short? Because it's a credit spread. What's the only way this could be a credit spread? You must have sold the more valuable call. We must be short the 100 call and long the 105. Now that we've figured that out, find the values of these options at expiration with the stock at 102. The $100 call is going to be worth -2 to us, right? That's a short call. We'd have to buy that back for 2 points. The 105 call is worthless. So on a net basis, we could close this spread for a cash outlay or a net debit of $2. And that's exactly the amount of the credit that we received. That's why the break even is 102. All right, let's try the fourth one, short put spread. Make up some numbers. Let's say we get a credit of 2. We therefore have a max loss of 3. And of course, we have a break even of 103. How do we know this? Well, you can refer to some formulas or just look at it visually. Again, from this strike, we must come down and to the left. which means we must subtract 2 from this strike from 105, which would give us 103. We can also look at the break even in relation to this strike. We would have to go up and over, which means we must add this many points to this strike. 100 plus 3 would again give us 103. But that doesn't really show you the mechanics of the spread. Those are just memorizing formulas, and of course they're very easy to forget. So let's step through it. Start up here at the top. It's a short put spread. By a short spread, it means you have sold it. It's a credit spread. What's the only way that this could be a credit? We must have sold the 105 strike and therefore bought the 100. We must have sold the higher strike put. That's the one that's more valuable. And so now that we know that, what are these options worth at expiration with a stock at 103? Well, the 105 put that we're short to us is worth -2. We'd have to buy that option back for $2. With the stock at 103, the 105 put is $2 in the money. The $100 put that we own is worthless. So to close out this entire spread would be a net debit of 2, and that is exactly the amount of the credit that we received, which means we would just break even. So again, that's just a really good series of drills you can do. Pick a couple of spreads, long or short, call or put, make up some debits and credits, figure out the break evens. But then the second part of the drill is to figure out which option you're long, which one you're short, what they would be worth at expiration, and then see if you can figure out why that break even must be true. That will greatly help you to understand vertical spreads without having to memorize formulas. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.